All right, guys, how's everyone doing? Let me get things set up here. What's going on, everyone? All right. Looks like you guys can hear me. Can you guys see the screen here? Just give me a quick shout out. You should be able to see the documents here and the charts. All right, perfect. Good, good, good. All right, let's get to it. First of all, so what we're going to talk about today, we're going to talk a little bit about just what's going on in the market right now. And then basically, I'm going to talk about what I talked about last week. We didn't get the recording. It should be recording this time, so we're good. And we want to have a recording on this topic here. To make it a little different, I added an example here on the risk that we'll go over with a current stock that we could have traded yesterday, that's CDNS. And that'll give you a good example of how long-term risk plays out. So we'll talk about that. We'll talk about trading psychology, and then we'll get to float next time. So this is basically a lot of review from last time. But let's get to what's going on today. We know today is Fed Day. So what are the expectations for today? Of course, we expect some volatility. What we'll probably see if we look at SPY here, you can see a pretty tight candle today, and we've had a lot of tight candles here in terms of the overall indexes. But we know what we're seeing in the indexes is not necessarily reflective of what we've been seeing with momentum stocks. We've seen a lot of volatility with momentum stocks. And when you start to see that, when the market's a little extended here, we're starting to get tighter ranges, even if it's floating higher, that's usually a signal to be cautious. That doesn't mean the market's going to tank, but we could see a pullback here, could be setting up. And, we know what the market's looking at in terms of and why there might be a little bit of kind of risk off in terms of people don't want to take as much risk. So they're going to, maybe go for the bigger quote unquote safer stocks or go for the index ETFs because we all know we see what was coming with earnings. We have obviously we've been waiting for today's Fed decision. This is a big week related to tariffs, and we're getting more tariff news today, and some other factors as well. And today was a big, or this week was a big week for economic indicators, and of course, in the next 2 days, we have 4 or 5 big techs reporting as well. So kind of a risk off mode, and when that happens, the momentum stocks start to see a lot of volatility. Now, end of July tends to be strong. What's interesting is we have this kind of strong period, a short strong period that tends to be followed by a very weak period, which is August. August tends to be a weak month. Again, that doesn't mean it's going to happen this month. So we know that's in play. In terms of the Fed meeting today, let me just pull up the intraday for SPY. What we can expect here is around 11 Pacific in about an hour and a half or two Eastern. Expect some volatility here. You can see how tight the ranges are. They're going to get, this is the intraday chart. Expect some volatility here. For those of you who day trade, we've talked about this before. What often happens is whatever the initial move is related to that initial Fed release at 11 before Powell starts talking, there tends to be a strong move in one direction or another, and that move gets faded. We don't talk a lot about day trading, but this is something I always watch for. Is that first move, whatever it is, almost always gets faded. So you'll see something like this. Like say the move is to the upside. So you have the like this coming into the Fed meeting. So these are 5 minute or 1 minute candles, whatever you're looking at. Let's say we get a big pop right when the Fed minutes are released. There will be a drop then, and you can fade that. You could go short here, or if it was the other way, if it went down, you could go long once you see the signal that is fading. And then at some point, a range tends to form, and then you wait for a break of the range. Sometimes that range never breaks, but if the range does break, often you'll get that move into the close in that direction, whichever way it fades. So those of you who are day traders, be on the lookout for that and study past Fed meetings, and you'll see this pattern play out a lot. It's almost a gimme. Like if these things set up here, this is what's going to happen. So for those of you who day trade, keep a lookout for that, and that This day it tends to be a very easy day to trade if you can catch these moves here, especially when there's volatility, a reaction to the Fed meeting. So there's that for those of you who are day traders and looking at the intraday stuff. For us who are swing traders, generally you don't want to make too big of a move on the day of the Fed or even the day after. It usually takes a few days for the true kind of trend to play out. And the other thing related to this Fed meeting is not only do we have this Fed meeting, we have new data coming in. Tomorrow will be more economic indicators. There's a tariff deadline tomorrow as well, 25% for uh, some other countries. I forgot which countries they are now. We have, of course, earnings coming up as well in a bunch of stocks. So we have that to pay attention to as well. So I would expect we'll get the trend next week. So don't be rash in your decisions. Again, as usual, that doesn't mean you can't make any trades, but I would say a little bit of caution over the next few days, regardless of what the Fed is. Now, related to what the expectations are, expectations right now are that there will be no interest rate change. And I think that's a very strong possibility if there was a surprise in either direction. It's not likely that rates would be increased, but if there was this huge surprise, that would probably tank the market short term. And if there was a surprise and there was a rate cut, obviously the market would react positively to that. So very low possibility of that, but sometimes these surprises happen. But most likely there's going to be no rate cut. And then we watch for Powell's commentary. And what the market is looking for this time is indications that there might be a September cut in play. So they're going to listen to Powell very closely. They're going to read the statement very closely to see if there's any changes that could indicate there's potential for a September rate cut. The reason for that is one, everyone's watching how Powell reacts to the pressure Trump has been applying. So there's that. But more importantly, two of the Fed heads, it's a board of Fed leaders, and two of them in the last month have indicated they expect rates to be cut or they think rates should be cut. So if, when you couple in the pressure Trump is applying, maybe Powell wants to escape the pressure related to the controversy over funding over the new Fed buildings and whatnot, and and then we have two Fed heads also saying rates should be cut. Maybe that could lead to a September cut. So the market is going to be watching for that very closely. If there are any indications that seem to favor the potential for that in September, we could see a very strong move coming out of this. So, and then of course, any negative kind of commentary would probably set the market pulling back. And these are all short-term things. And then of course, the market will reset itself after a little bit, and we want to see where the trends are. So that's what we'll be watching. So a lot to think about. A lot of times we have all these things that we're thinking about, and the Fed meeting happens and it's kind of a dud, and nothing really happens, and we're just happy to have it out of the way. So we'll see how that plays out. But obviously, big news later today. Then of course we have earnings coming up. And let's just see which stocks are reporting today and tomorrow. We can see Meta, Microsoft, Amazon, and Apple, four of the big ones, right? So these are going to have a huge impact on the next 2 days, and of course next week as well. And then next week we have AMD and Disney. Not quite as big here, but especially for stocks we trade. We've seen Disney as a potential bottoming formation here, and look at the range here. If Disney could break this range, it really sets up for a big potential move. And they have the Fantastic Four movie, which has been putting in big numbers too. So maybe that'll lead to some upside here. And of course, AMD here, we can see here has made a very strong move, and we'll see how earnings play out here as it tries to test the old high here. So a lot going on in terms of earning, and these are just the big tech stocks. If we look at some of our lists here, a lot of stocks we can't really trade right now because they have earnings coming up. You can see here on our Focus 40, or actually 55 stocks, between this week and next week, we have 35 out of 55 reporting, and a bunch have already reported as well. So we have a lot of earnings coming up. We have a lot of stocks we've added to our earnings breakouts and breakdowns list. Right now, I've got about 25 stocks. I probably have about 7 or 8 to add today, so we'll be in the 30s right now. So we have a lot of stocks to be watching as potential earnings plays, and we should be familiar with those earnings setups. CDNS is one we're going to use right now for our example related to risk. And as usual, if you guys have any questions, post them in the chat here. Looks like we have one question here from Danny. What is considered safer stocks assets for possibly a weak month? Um, there's obviously, the Dow type stocks, the Pepsis, the Cokes, the big. It tends to be the big float stocks and the big cap stocks, right? So the Apples and the big tech stocks as well, or just the indexes. But those can pull back a lot too. So I don't. For me personally, when I say these safe stocks, I'm not talking about for me to trade. This is just what the big institutions are doing, and we're not necessarily doing anything even close to that. But what we're assessing is what they're doing. For us, we're still taking a look at our technical analysis, our patterns, and we could still like some momentum stocks. And even though a lot of the momentum stocks have been volatile and pulling back, there are plenty of momentum stocks that are not and are still in good patterns and haven't really pulled back. So for us necessarily, I wouldn't be looking for safe stocks. We're just assessing why the market is looking the way the market does related to some of the momentum stocks. All right. Now, last week again, we talked about risk and long-term risk and win rates, and how to manage our trades and how that relates to trading psychology. And the reason this was spurred on for me is a number of you got shaken out of the Oklo trade, which was a very good trade. Stop was never hit. I think it pulled back close to entry level, but I don't think it. I can't remember now, but I don't think it violated entry level. And we had talked about it. Let me actually pull up Oklo up. You can see Oklo here. And my take on it, this is when it happened. You can see we entered here on the break of the old high, essentially a breakout pullback remount. The stock ran up and was looking fantastic. We were targeting a little higher than the top of the range because we talked about how oftentimes this type of setup will test the range, but will actually break through a little bit and we can get a little more profit out of that. And that's essentially exactly what has happened here. But notice here, we had a little bit of volatility here on no real news event here with Oklo on this day. And this shook a lot of you guys out. And then you can see the next day here. And I had said during this period, I was going to stick with it, that nothing had really changed in terms of the setup. The overall setup had not been violated. Uh, the volume on the pullback was very low. And you can see it held this level and hit our target, and we got out of it for a good trade. But my guess is, just from talking to a lot of you, that at least half of you who were in this trade got shaken out here. Now, it's not a huge mistake if you want to play it that way and just say, hey, you know what? I just want to get my break even here and get out of it. But I think if you do this over time, you're going to get shaken out of a lot of trades because very few trades will just perfectly go to your target. On the way to the target, there's red candles, there's pullbacks, and you'll get shaken out of too many trades where you're going to end up hitting, your 2.5 to 1, your 3 to 1, which is what we got here. I think it ended up being like 2.8 or 2.9 to 1. And so you have to be able to assess um, the analysis of the trade setup itself, and then also understand risk and your trading over time. And I think that will help a lot of you guys who are essentially living and dying by each trade. You get in a trade, you start watching every tick, and you're really focused on that one trade you're in right now. When what your real focus should be is on the process, doing the right things, and thinking about, am I doing the right things for the next 100 trades? And as long as I'm doing the right things, the result of this trade is almost meaningless. And you'll see it with me. When I get stopped out of a trade, I never really get up or down on it unless I feel like I made a big mistake on the trade. So let's talk about that. Again, for some of you guys, this is a review because you were at the pop-up session last time, but we need to get the video out of this, and I added a little to it. So we'll get some new stuff in here as well. So let's talk about risk. And Let's take a look first at risk comparisons and profitability. So let's look at this chart here. So here we're looking at 100 trades where our win rate is 50% and we're risking $100 per trade. Now, if you're risking $100 per trade, that means you probably have around a $10,000 account. Because generally we want to be risking about 1% per trade. And remember, risk is not your position size. Your risk is $100. Your position size could be $5,000, $10,000. But that is how much would you lose if you get stopped out on the trade. So we're assuming $100 risk per trade over the next 100 trades at a 50% win rate. Now, if we look at this, let's start with 2 to 1. That's generally kind of our starting point. Most of our trades, we want to be 2 to 1. And in general, when you're trading, if you're averaging 2 to 1 on your trades, you're doing very well. So if we are trading at 2 to 1 at a 50% win rate, meaning over the next 100 trades, we win 50 times, we lose 50 times. When we win, our profit is going to be $200 per trade. When we lose, we're going to lose $100 per trade. So our total wins, profit from our wins, not subtracting anything, is $10,000. Our total losses is $5,000, 550 trades times 100, meaning our net profit is going to be $5,000, assuming we're not having any commissions or anything. Most of you guys are either on no commission or very low commission, so we don't have to worry about that. So if you have that $10,000 account, after 100 trades, if there aren't any huge drawdowns and you're pretty consistent, you're going to be somewhere around a account value of 15,000, right? So essentially a 50% gain here off 2 to 1. So you can see the power of your risk reward, 50% win rate. If you're doing everything right, you're essentially break even on your trades, but you're trading at a good risk reward. You're going to end up making a 50% gain over 100 trades. That's huge. Not easy to get a 50% gain for anybody. Most professional traders are happy with, 10% gains in a year. And here you're getting 50% if you're doing this. Not easy to do this. It sounds very easy, 50% win rate. But now let's look at 3 to 1. Let's say you're getting a 3 to 1 risk reward, essentially close to what we got on that Akko trade. And you still have a 50% win rate. Now your wins are $300 per trade. Your losses are still 100. Now you're making 15,000. You're losing 5. Your net profit is 10,000. Your account size is now 20,000. And now you have a 100% gain, right? And then same with 4 to 1. Now 50-50 again. But now your profit is $400. Your loss is $100 again per trade. 20,000 in wins, 5,000, still 5,000 in losses. Your net profit is 15,000. Now your account is 25,000. So you can see the power of risk reward and why I am always so focused on it and why I almost never want to take 1 to 1 trades. I get a lot of questions in the chat and emails that our stock has gone up, a certain amount, and I'll say, hey, we're only at 1 to 1. Even though this was a nice gain, we're only at 1 to 1. And I'm not really worried about this trade. What I'm thinking is over my next 100 trades, if I trade like this, I'm not going to be successful. So you have to be getting that good risk reward. Now, one caveat to this, I made everything constant here, 50% win rate, right? I made the win rate constant, 50%. Now, this can vary a lot. Someone just mentioned here they have more of a 30% win rate right now. That might be in a short period of time. You want to look at it, you have drawdowns too. When we say 50% win rate, it's too bad that it just doesn't go 1-1, 1-1, 1-1 all the way to 100 trades, right? That would make it very easy. Sometimes you'll win 7 or 8 in a row, or sometimes you'll lose 7 or 8 in a row. So it's not steady, and that can affect the profitability as well. But it'll be pretty close if you end up around 50%. The other thing is, as you go from 2 to 1 to 3 to 1 to 4 to 1, your win rate will likely drop a little bit. It's much easier to get 50% win rate on 2 to 1, and you might get 55% or 60%, than it is at 3 to 1 because you're going for a higher target, and the stock's not always going to hit that higher target, right? So your win rate can drop as your risk reward profile changes. So keep that in mind. But I just use this as an example. It's not exactly how it's going to play out. You might have, if you have 4 to 1 at a 40% win rate, that's actually better than 2 to 1 at a 50% win rate, which can be a little frustrating that you're losing 60% of the time. But you have to think about profitability, not win rates. And you're actually winning more at 40% at 4 to 1. Okay, so let's go over some growth examples here. We kind of did that here when we looked at the outcomes here, final account. But starting capital, $10,000, risk per trade, 1% of your account size. So we're going to risk $100 per trade, right? And again, I'm just using small account, $10,000. But this same thing, if you have a $100,000 account, now you're risking $1,000 per trade. If you have $1 million account, you're risking more, $10,000 per trade. So it varies according to your account size, but think of that 1% risk. And generally, for me, my risk range is 0.5 to 1.5%, depending on how strong I think the market is. Every once in a while, I'll go up to 2%. 2% is on the high side. Because think about it, you lose 5 trades in a row, your account is down 10%. So it's getting a little high. It doesn't sound like a lot, but it can accumulate very quickly if you have some losses. Okay, so risk reward 2%, 2 to 1, win rate 50%. Now let's say total trades 300. That's with the expectation you're trading very aggressively. Maybe you're using bull call spreads, which we've gone over, and some other things to get more trades in. And you have 300 trades in a year. I tried to kind of mimic what could happen in a year. Again, 50% win rate, so 150 wins, 150 losses. And now we're doing something a little different. I kept risk constant here, but your account is growing, right? At $10,000, you risk $100 per trade. But at $15,000, you still shouldn't be risking $100 per trade, right? Now you should be risking 150 per trade. And then your 2 to 1 wins you more. Also, now you win 300 instead of 200. So you can see this exponential growth as your account grows, right? So now what we're going to say is you don't want to do this for every dollar your account goes up because it's going up and down and you're going to be risking 115 one day, 90 one day. But let's say you have markers for your increase. You're at 10,000. You could say at every 15,000, every 5,000, you're going to increase your risk. So when you get up to 15,000, you'll increase it. I did it at 2,000 here. So for every 2,000 increase in your account size, you're going to recalculate your 1% risk. So essentially, you'll use $100 per trade from $10,000 to $12,000 on your account size. Once you get to 12,000, you do the 1%. And now you start risking $120 per trade. So again, here, if your account is at 10,000, you risk 100. When it gets to 12,000, you risk 120. When it gets to 14,000, you risk 140, and so on. And you can see here now where you were at 2 to 1, and because you're doing it exponentially and you're increasing your risk as your account grows, now at 2 to 1, instead of your account value being 15,000, I've also added more trades. It's 300 trades instead of 100, but it still would grow quite a bit more. Your final account value would be 36,000. So total profit 26,000 if you were trading, perfectly in this scenario. So this shows you here the kind of compounding that is happening as you're trading, and you want to be thinking of this in terms of your portfolio growth. So if you're thinking in this way, it's going to help with your trading psychology because your mindset is going to trade. You're going to focus on process, not result of this any one trade. And I think that's what too many of us do is we get in a trade that we like right now and we're watching every tick, micromanaging the trade, upset if we get hit at our stop. And when you get upset, your emotions run high, you start making other bad trades, leads to a whole slew of other trading kind of mental leaks. So, but if you're thinking in these terms where I don't even care about this one trade, I know I'm going to lose 50% of the time and I'm fine with that. I'm embracing that because I know if I do trade this way over time, I'm going to be successful. If you think in those terms, you're going to make a lot less trading mistakes. And over time, that's huge for your account growth. And here is a chart of the compounding growth when we're increasing our risk, and you can just see how powerful that is. Now let's look at this and look at some multiple scenarios with a sample trade. So what I just went over right now, we went over last week, but now we're adding this trade here. So let's actually look at kind of a real world example here. Let's say CDNS. There's CDNS here. Notice here that we had the breakout yesterday. Let's say we just decided we love this setup. This is kind of a box continuation pattern setup. We got the breakout here, and for some reason, this is telling me my session is going to end in 10 minutes. I'm supposed to have about 20 minutes more. So wherever it stops here, we'll continue tomorrow. We'll do another pop-up session tomorrow. But notice here, we have the breakout here. Let's say we entered yesterday. We weren't, we weren't going to dilly-dally with pullbacks or anything. We were just willing to enter here and kind of hold on. So let's say we entered yesterday at 366. We placed our stop at 352, so 14 points. Okay. And let's say you have a $100,000 account. We've been using 10,000. But for those of you with bigger accounts, let's use another example. But the same applies no matter what your account size is. The same. You just use a different risk. So let's say we're risking we take 100 shares. We're risking 1,400 per trade. So we're doing 1.4% instead of 1%. Now let's look at the impact of risk at 2-to-1, of 3-to-1, and of 4-to-1 at different win rates. Okay, we kept the win rates constant here, but let's look at how different win rates impact it. So let's say we're at 2-to-1. So this chart here, 2-to-1, 2-to-1, 2-to-1. So in each of these trades, our stop level was 352. Our target price was 394. The only thing that changes is our win rate. We win 40% of the time, we win 50% of the time, we win 60% of the time. Notice, even at 40%, you're making money, right? Profit per win, 2,800. I didn't put the profit. I did put profits for loss, 1,400. Your net profit is 2,800. Your account, this should be actually 280,000. And then here's the final account value. Notice if we are at 50%, how much that changed. It almost doubles with that 10% difference in win rate. And then notice if you have a really good run and trade at a 60% win rate, it goes to 112,000. Now look at the 3-to-1s. Now instead of 2-to-1, you're getting 3-to-1. Now notice here, 3-to-1 at that 40% win rate, you are making 84,000 instead of 28,000. So here you have, well, actually, sorry, I don't want to, let's compare this. Let's compare 3-to-1 at 40% versus 2-to-1 at 50%. Notice the 3-to-1 with a 10% lower win rate, you're actually making more money, 84,000 versus 70,000. So it can be a little frustrating, to lose 60% of the time. But if you're thinking of this long term, you're going to end up making more money this way. And then here's the 4-to-1, and you can see the difference in the compounding as well. So this shows if you took CDNS and you traded a similar setup to this 100 times, obviously you wouldn't trade CDNS 100 times, but say this kind of breakout setup, you were able to trade 100 times, you can see the impact on your account growth. If you want to calculate this, here's a formula. I don't think most of us are going to want to do that. But here is the formula here. So the point of this is the way you should be thinking. You should be thinking in terms of R's, in terms of your risk. So in terms of the way you should be looking at your trades, and looks like we're going to be knocked out of here in 6 minutes, so I should be able to get through this in that much time. First thing you want to do when you're in a trade, you want to do the hard work. The hard work is done before you enter the trade. So I'm going to be looking, is this the right setup? Where is my entry level? What should my risk reward profile be? Where am I most likely to hit my target? Where is a good stop level? Is the market cooperating? Is the industry? All these things we always talk about with our trades, right? That's the hard work. That's analysis. That's calculating your risk reward. That's thinking about your portfolio management. How many positions do I want to have at this time? Do I want to be correlated or non-correlated? Do I want to have a lot of stocks in one industry, right? After you've done all that, now you take the trade, and now you're out of setup and entry mode, and you're in trade management mode. This is where the psychology comes in, because when you're in trade psychology mode, this should be the easiest part of your trade. You're done with the hard work and you just watch. It's almost like watching a horse race at that point. You just sit back and you watch. You've done the work, you've placed your trade, and you wait for your stop or your target to hit. And if your process is good, you almost don't care. You just wait for one of them to get hit. The only time you make an adjustment, and this is a problem with a lot of traders, I see it in the chat, every little move while it's going up and down, you're thinking, should I get out? Should I take this small profit? You don't want to be taking small profits. And if you get out on every little red candle, you're going to get out of a lot of good trades, like we saw with the Aqua trade. So this is mostly where the trading psychology leaks come in. You don't want to be doing too much analysis. You essentially want to be in set it and forget it mode. It's a race to your target or your stop. Occasionally, you will make strategic adjustments if something major happens, a major news event, some news related to your stock or the market. If the setup actually changes while you're in it, like you had a breakout setup and all of a sudden the breakup setup is gone, even though you haven't hit your stop yet. But this should be occasionally, maybe one out of every 20 trades, you do something like that. If you're constantly doing something like that, you're doing something wrong. It happens occasionally. You can't control everything after you're in the trade. It usually means you're micromanaging and you're getting out of too many trades that you should be sticking in with. So the key takeaway from this kind of analysis is you need to be thinking long-term risk, process, not result for each of your trades. You are thinking about your result long term, but each trade almost doesn't matter as long as you're doing the right thing. You're trading the correct process. So think in terms of your next 100 trades, not the trade you are in right now. Think of your overall risk reward, the process that leads to long term results. You know you're going to lose anywhere from 30 to 60% of the time, right? You have to be comfortable. You have to embrace losses. Embrace small losses as long as they are 1R. If you're taking big losses, then you're doing something wrong and you should be upset with yourself. But if you're taking a 1R loss, it's fine. If you did everything correctly. So again, your current trade almost does not matter as long as the process is good. Long-term results should follow. So don't live and die by every trade, every tick. Remember that big wins are good and also small losses are good. Be happy with yourself if you have a small loss and you feel like you did everything correctly. And then, a lot of trades just aren't going to win. If you have a small win, that is bad. I know this sounds counterintuitive, but I would like it to have a small loss where I did everything right rather than a small win. If you're having a small win, you did something wrong. So you don't want small wins. And of course, you don't want big losses. That's where you have to assess what's going on here. Every once in a while, you are going to take a big loss. A black small swan event happens. A gap down against you happens. We can't control that. But if it's happening too much, there's something wrong with your trade. And those things are bad. So that's the way you want to be thinking in terms of your overall process. If you start thinking this way and you're trading the correct process, over time, results are going to follow. You're going to start making a lot less trading leaks. Your trading psychology will improve as well. All right, guys, I'm going to get kicked off here. I wanted to do a Q&A. But for now, that kind of rehashes what we went over last week. Either tomorrow, Friday, we'll continue with this. We'll talk more about what happened in the market. And of course, the big techs are going to report. And then we'll get to float. Maybe we'll do this on Friday. Real quickly, Sea Turtle's asking if your account decreases, do you decrease your risk? You should have that process and level set. Like if you're a $10,000 account and you go down to 95 or 9,600, I would keep it at $100 per trade. But yeah, you're exactly right. If I went down to 8,000, then you shouldn't still be trading at $800 risk. You should be going down to around $80 risk. So you're right about that. You should have levels to the downside as well to protect you on those drawdowns as well. Great question there. And I'll add that's actually such a good point that I'll put that in our notes as well. All right, guys, the recording to this will be out later today. I'm going to put the report out before the Fed meeting, and in the chat, we'll cover what happened during the Fed meeting. All right, guys, talk soon.